What if you could walk into your bank and pull out $30,000 of your own cash? No questions asked. For over 50 years, an ancient banking law has treated you like a criminal for withdrawing even a third of that amount. But a quiet revolution is coming that the big banks are praying you don't discover. A new proposal is making its way through Congress that could finally give you back control over your own money. This is the biggest transfer of power from them to you in decades. Stick with me, because I'm going to break down this new $30,000 rule, expose the invisible walls the banks have built around your money, and give you a step-by-step plan to beat them at their own game, starting right now. Hey everyone, I'm Ryan. On this channel, we don't chase money, we build systems that generate it. I break down real wealth strategies, asset building frameworks, and financial truths most people never learn. If you're serious about growing your money the smart way, subscribe now and hit the bell icon. Let's build something that pays you back. For more than half a century, the American banking system has been running on a rule that makes regular people feel like criminals for trying to get their own money. It's called the Bank Secrecy Act of 1970, and it's the reason you get that knot in your stomach when you need to pull out a large chunk of cash. Under this law, any cash transaction over $10,000 gets automatically flagged and reported to the government. That report is called a Currency Transaction Report, or CTR. Now, this was all set up with the good intention of fighting money laundering and other major financial crimes. But let's put that number in perspective. That $10,000 limit was set back in 1970 and has never, not once, been adjusted for inflation. Do you have any idea what $10,000 from 1970 is worth today? Roughly $80,000. That means the rule today is about 8 times more restrictive than it was ever meant to be. A transaction that was genuinely huge back then is now the price of a decent used car, a small business stocking up on inventory, or a down payment on a house. This has created a chilling effect. The system has basically trained us to be scared of our own cash. We worry that taking out a big sum will land us on some government watch list, or that the teller will give us a suspicious glare. It's created a flood of paperwork for banks. They file over 16 million of these reports every year. And most of them are for totally normal transactions by regular, law-abiding people. The American Bankers Association's own president has called this rule outdated, inefficient, and increasingly counterproductive. He says it's a system drowning in data that offers minimal law enforcement utility while creating growing privacy concerns for bank customers. And this feeling of being controlled doesn't stop with the government. The banks have layered their own maze of rules on top of it, all designed to keep your money right where it is, with them. They make money when your cash stays in their accounts, and they make money when you, unable to easily get your own funds, are forced to use their high-interest credit cards and loans. It's a game where the house always seems to win. Until now. Because the push to finally rewrite these ancient rules is gaining steam, and it's about to hand you a brand new playbook. So, on one hand, we have this ancient $10,000 government reporting rule. But the problem gets way worse when you look at the day-to-day reality of banking. The banks themselves have built their own invisible walls to make getting your cash even harder. These walls are called withdrawal limits, and they are set entirely by the banks, not by any federal law. Ever been in a bind, rushed to an ATM, and been told you've hit your daily limit? That's wall number 1. Most banks cap daily ATM withdrawals at ridiculously low amounts, often somewhere between $500 and $2,500. That limit is cumulative, so once you hit it, you're done for the next 24 hours. It's like they've given you a tiny keyhole to access your own vault of money. The second wall is the myth of unlimited access to your savings. For years, a rule called Regulation D limited you to just 6 convenient withdrawals from your savings account each month. In April of 2020, the Federal Reserve officially suspended this rule, which should have been a massive win for everyone. It meant you could, in theory, access your savings as much as you wanted. But here's the catch. Many banks just pretended it never happened. While they are no longer required by law to enforce that 6 withdrawal limit, they are still allowed to. So, many of them just kept the old rules as their own internal policy and continued to charge you fees if you dared to go over 6. It's the perfect example of how the system is rigged. When a rule helps the bank, it's law. When it helps you, it's optional. This is what's so frustrating. It's your money. You worked for it. You gave it to them for safekeeping. Yet when you actually need a large amount for an emergency, a family crisis, or a big opportunity, you're hit with limits, suspicion, and paperwork. You have to ask for permission to use your own money. And that's the real pain point. Feeling powerless. You're treated less like the owner of your money and more like a user with limited privileges. Think about it. The bank's whole business model is based on using your deposits to make loans and rake in profits. A healthy cash reserve in your hands is a direct threat to their lending and credit card business. The less cash you have, the more likely you are to need their high-interest loans and lines of credit. Those invisible walls aren't just for security. They're a central part of their profit strategy. They keep you dependent. They keep you in the game. But what if you could just get up and walk away from the table? This is where the game is about to get a major shakeup. For the first time in over 50 years, there is a serious bipartisan effort in Congress to tear down the outdated system we've been talking about. It's called the Streamlining Transaction Reporting and Ensuring Anti-Money Laundering Improvements for a New Era Act, or thankfully, the STREAMLINE Act for short. This bill, introduced in the Senate in late 2025, is the new rule this video is all about, and it takes direct aim at that ancient $10,000 reporting threshold. So, what would it actually do? First, and most importantly, the STREAMLINE Act proposes raising the currency transaction report threshold from $10,000 all the way to $30,000. This is the magic number. It's not just a random increase, it's a desperately needed update. Tripling the limit would instantly get rid of that feeling of being watched just for pulling out a 5-figure sum for a legitimate reason. Buying a car, paying for a wedding, or building an emergency fund in your home safe would no longer trigger an automatic government report. In one move, it would slash the number of these filings by an estimated 40%, freeing up bank resources and, more importantly, giving millions of Americans back their sense of privacy. But the bill gets even smarter. The second key part of the STREAMLINE Act is to index the new $30,000 threshold to inflation. Every 5 years, the limit would be automatically adjusted based on the Consumer Price Index. This is a huge deal. It means we'll never end up in this mess again. The rule would finally evolve with the economy, making sure it targets genuinely huge and suspicious transactions, not the everyday business of normal people. If a system like this had been in place back in 1970, the threshold today would already be close to $80,000. This proposal has a ton of support from groups ranging from the American Bankers Association to credit unions and community banks. They all know the current system is broken. It creates a massive headache for them and doesn't even help law enforcement go after the real criminals effectively. As the president of America's Credit Union said, modernizing these thresholds is a common sense step that reduces unnecessary burdens without compromising safety. It lets banks focus resources on truly suspicious activity rather than routine transactions. This proposed $30,000 rule signals a massive shift in thinking. It's an admission that the balance has been way off, the net has been cast too wide, and the privacy of everyday citizens has been ignored for far too long. While it's not law yet, the fact that it was introduced with bipartisan backing shows that change is coming. But you don't have to wait for a bill to pass to start taking your power back. Understanding this is only half the battle. The other half is using the rules that exist today to your advantage. The promise of a $30,000 rule is incredible, but we have to live in the now under the current $10,000 system. The great news is, you can still operate with a ton of freedom if you know how the game is really played, not how the banks want you to think it's played. Here's your step-by-step plan to build a powerful emergency fund and take back control of your cash today. Step 1. Know the difference between the ATM and the teller. This is the single most important thing to get. Your ATM withdrawal limit is a low, fake ceiling made for the bank's convenience and security. It's usually just a few hundred or maybe a couple $1,000s. Your real access to your cash is a human teller inside the bank. There is no federal law that limits how much cash you can withdraw in person. Banks set their own internal policies, but these are often $20,000 a day or even higher. The main reason is they can verify who you are right there, which removes most of the risk. So, if you need $8,000, don't try to hit 10 different ATMs. Just walk into the branch. You are legally entitled to your money. Step 2. Take the fear out of the $10,000 report. You need to burn this into your brain. A currency transaction report, CTR, is not an accusation. It's a neutral, administrative form the bank is required by law to file for transactions over $10,000. Withdrawing $11,000 for a down payment doesn't make you a suspect. The bank is just doing its job. Don't be afraid of it. And more importantly, never try to get around it by doing what's called structuring, making several smaller withdrawals of, say, $9,000 with the specific goal of dodging the report. That is illegal and is a massive red flag for the authorities. If you need $15,000, withdraw $15,000. Be open about it. It's your money, and you have nothing to hide. Step 3. Inform. Don't ask for permission. If you need a very large amount of cash, let's say over $20,000, the smart play is to call your bank branch a day or two ahead of time. But how you phrase it is everything. You are not calling to ask for permission. You are calling to inform them. Say this: "Hi, I'm just giving you a heads up that I'll be coming in on Friday to make a cash withdrawal of $25,000 from my checking account. I wanted to let you know in advance to make sure the branch has enough cash on hand to handle it without any issues." This language makes you sound like a confident and prepared account holder making a courtesy call. It's professional, it's assertive, and it guarantees a smooth process. Smaller branches don't keep unlimited cash in the vault, so this is just a practical step. Step 4. Build a tiered emergency fund. Financial freedom is all about having options, so don't keep all your emergency money in one place. Structure it in 3 tiers for maximum safety and access. Tier 1. Immediate access. This is your get-out-of-Dodge fund. It should be 1 to 2 weeks of living expenses, held in physical cash and stored somewhere safe in your home. This protects you from power outages, natural disasters, or bank holidays when you can't access your money digitally or physically. Tier 2. Rapid access. This is 1 to 3 months of expenses in a high-yield savings account. But here's the key. Make sure it's at a bank you have confirmed does not enforce the old Regulation D withdrawal limits. Call your bank and ask them straight up. Do you limit the number of withdrawals I can make from my savings account each month? If they say 6, it's time to find a new bank. Plenty of online banks have totally dropped these limits and fees. Tier 3. Long-term reserves. This is the rest of your emergency fund. Another 3 to 6 months of expenses, kept in a low-risk, liquid investment account. This money is for bigger, long-term emergencies and helps your savings grow faster than inflation. By taking these steps, you're not just managing your money. You're building a system of financial independence that makes you far less reliant on the banks and their expensive credit products. You're playing by your own rules now. If you found this valuable and you want to keep learning how to take back control of your financial life, make sure you hit that subscribe button and turn on notifications. The financial world is changing fast, and we put out regular videos to keep you one step ahead. And I've got a question for you. What's the single most frustrating thing about your bank? Is it the tiny ATM limits? The fees? That feeling of being watched? Drop your answer in the comments below. I read every single one, and your feedback helps me create content that actually helps you. The power dynamic between you and your bank is on the brink of a historic change. The proposed STREAMLINE Act, with its $30,000 reporting threshold, marks a long overdue return to common sense and privacy for all of us. It's a clear sign that you should be able to use your own money without feeling like you're under a microscope. But the biggest lesson here is that you don't have to wait for Congress to become financially independent. Real power comes from knowledge. It comes from knowing the difference between a bank's internal policy and the actual law. It comes from understanding that a government report isn't a criminal accusation. And it comes from setting up your finances in a way that gives you maximum freedom and flexibility. By using the strategies we talked about today, using the teller, communicating with confidence, and building a tiered emergency fund, you're taking a huge step toward beating the banks. You are shifting from a position of dependence to a position of power. You are building a financial fortress that protects you not just from life's emergencies, but from the very system that's designed to profit from your vulnerability. The rules of the game are changing, and now you finally have the playbook to win.